Welcome, and thanks for tuning into KBRA podcasts. We cover topical research discussions, industry commentary, and more. As we continue to expand globally, KBRA Podcasts is a go-to source for timely briefings directly from our knowledgeable team members. In this episode of KBRA's Structured Finance Outlook series, Brian Ford, Senior Director and Head of KBRA's Structured Finance Research, leads the discussion on the 2021 outlook for the ABS sector. He's joined by Rosemary Kelley, Head of KBRA's ABS team, Eric Neglia, a Managing Director in our ABS consumer team, and Cecil Smart, Managing Director in KBRA's commercial ABS sector. The team examines recent ABS credit trends, spread performance, supply expectations, rating changes, as well as recent performance in our auto loan and unsecured consumer loan indices. Stay tuned to learn more.
Hello, everyone, and thank you for joining our Structured Finance podcast series, where we'll be discussing KBRA's outlook for the ABS, CMBS, RMBS, and CLO markets in 2021. Today, we'll be discussing how the ABS markets held up so far during this year amid the pandemic, as well as what our expectations for credit fundamentals and new issue supply are in the year ahead. My name is Brian Ford, and I head up the Structured Finance Research Group. And with me today is Rosemary Kelley, who heads up our entire ABS ratings team, as well as Eric Neglia and Cecil Smart, who run our consumer and commercial ABS groups respectively. Thank you all for joining. So let's get right into it. Last week, we published our ABS Outlook, where a lot of the focus was on the health of the U.S. consumer. So Eric, I'd like to go to you first to talk about what we've seen in terms of credit fundamentals this year, as well as what we're thinking about in terms of performance on the year ahead.
Thanks, Brian. Pleasure to be here. So as far as consumer credit fundamentals through COVID, the 7 months into the pandemic, we feel the consumers held up surprisingly well. Unemployment's now at 6.9% and expected to remain above 6% for most of 2021. While this is elevated, it's down significantly from the peak of 14.7 in April and lower than what many were predicting back in the spring. Delinquency rates and annualized net loss rates are also lower than forecasts and generally lower than this time last year. We do believe that this better than expected performance is because the consumer's in a strong financial position and they've benefited from massive relief measures targeted directly at the consumers and small businesses. In addition, the average consumer had lower leverage and higher savings than they did going into the financial crisis last time, which puts them in a better position to make their debt payments. Additionally, as I mentioned before, the consumer was benefited from the massive relief measures and did use those additional stimulus checks, the enhanced unemployment benefits, and the extra cushion created by debt forbearance to pay down outstanding debt. As far as expectations go for next year, with delinquencies and loss rates currently below pre-pandemic levels, we expect credit performance metrics to normalize over the next several months. And then after that, it really depends on the path of the virus and any new government-imposed lockdowns. It also depends on the availability of the vaccine, the economic recovery, including unemployment rates, as well as the form and size of any new stimulus. If all these factors move in a favorable direction, you can expect to see continued strong performance. I do expect a mix of positive developments and some setbacks. So while I remain optimistic on a number of fronts, we continue to factor moderate weakness into our surveillance and new issuance analytics to support our ratings.
That's interesting. So I guess, I'm curious from your perspective, and Rosemary, I'd love to hear your view. What are some of the upside and downside risks to these expectations next year in terms of credit fundamentals?
Sure. Thanks, Brian. I think that the upside and downside risks are kind of two sides of the same coin. So we're looking right now at the current resurgence in the virus. And the question is the scale and intensity of that resurgence, as well as the resulting lockdowns. We really don't know how long that's going to persist as we're, moving into the winter months. And, where across the country that's going to be impacting folks. Secondly, looking at the timing and availability of the vaccine. I think there's a lot of excitement now for the vaccine announcements that have come through But the question is, how long will it take to roll those out and how effective will the vaccine be? Also looking at the potential for more stimulus. And we have right now some further borrower relief measures that are expiring in some segments, such as mortgages and student loans. So the question is whether they will be extended or we'll have, new borrower relief measures. And then just the overall shape and duration of the recovery is kind of a big point going forward.
So I agree with Rosemary. I think the major downside risk, as Rosemary mentioned, is the increase we're seeing in the number of COVID cases and the hospitalizations as people move indoors during the colder months, as well as the government's, looking to institute lockdown type restrictions, which could potentially slow the economic growth and cause unemployment to increase. As far as the upside scenario, I'd expect Congress to come to some sort of compromise and provide another round of stimulus to help the consumers until the virus slows and then the economy is on more stable footing.
Great. So, I seem to remember in the last crisis we went through more than 10 years ago at this point that there was a lot of tiering in terms of how borrowers chose to pay their loans. I seem to remember that auto loans performed very well through the financial crisis, while a lot of borrowers chose to selectively default on their mortgages. Have we seen any type of that loan tiering during this current pandemic?
So far, we're seeing strong performance across all consumer asset classes. This includes autos, cards, unsecured consumer loans, student loans, and solar loan and home improvements. However, one area of tiering is in the percentage of accounts that are in hardship assistance. If you look at auto and unsecured loans, those have generally had the same enrollment rates, while credit cards experience lower enrollment rates, likely due to the small variable monthly payment amounts. We've also seen low enrollment rates for solar loans, and this is likely due to obligor credit quality, the payment priority, and the view that the loan payment is potentially replacing a higher cost utility payment. If we do segment some of the performance by credit score, one thing that we have seen is that there's been a larger drop in delinquency rates for borrowers with lower credit scores, and this is likely due to the larger impact the stimulus has had on their income. For example, many low-income borrowers who were receiving the stimulus plus the enhanced unemployment benefits may have seen their income go up compared to what they were receiving when they were actually employed.
So I just wanted to add, Eric, I think one point that's interesting now is looking at the duration of the borrower relief programs that have been provided. So when you look at the tiering, it's hard to say quite yet whether or not there's been complete tiering and that there's been a change in the payment priority. But in RMBS, the extensions have been significantly longer, or deferrals, like 6 months versus something like 3 months in most of the consumer-related asset classes. So to the extent that borrowers have not had to make those mortgage payments, but then those relief efforts roll off, it'll be interesting to see if the payment priority changes as those obligations become due once again.
So it's great to hear that the U.S. consumer has been performing well through this last 8 months of the pandemic. I'm curious, from a ratings perspective, are we looking at these credits any differently today than we did back in, say, January and February before this all started?
We haven't adjusted our rating methodologies, but as you would expect, we've incorporated economic scenarios related to the impact of COVID into our ratings analysis. These scenarios have been updated since the start of the pandemic to reflect our current economic outlook and observed performance to date. Our scenarios are different depending on the asset classes and any underwriting changes implemented by the originator. For our outstanding ratings, we run these sensitivity scenarios to gauge the rating stability if performance worsens. Case in point on this is KBRA recently completed the resolution process on 244 watch placements across the unsecured consumer, auto ABS, and credit card ABS sectors. These 244 securities were placed on watch downgrade or developing back in April or May due to the credit performance concerns that we had related to COVID-19. Since our watch placement, we monitored the pandemic's impact on the economy and then credit performance. And then by November, all ratings in these sectors, which were previously on watch, were removed from watch status and affirmed due to the performance that we've been seeing to date, which was much better than expected. For new issuance, we incorporate what we're calling an adjustment factor that accounts for potential credit deterioration due to COVID-related economic factors that haven't yet been shown up in static pool or portfolio performance measures. As a result of this adjustment factor, credit enhancement in general has increased to support the same ratings.
And one thing I just wanted to add on that is in terms of adding this adjustment for the economic environment, this is something that KBRA does throughout our rating process when we're looking at historical performance data, especially on consumer assets, and trying to incorporate variables that can impact the performance or our expected performance of the collateral. We factor in the economic environment and then look at potential stresses on top of that.
Great. So turning to the solar ABS market where we're extremely active, how have these deals performed during the pandemic?
So as I mentioned earlier, enrollment in assistance programs has been low for the solar sector, been around 1 to 2% of the total portfolio compared to other consumer sectors, which have seen high single digits or low double digit enrollments. Additionally, early stage delinquencies remained low due to borrower credit quality. We feel the strength of the homeowner is a positive factor in the sector, given how credit scores of homeowners have generally increased since the last recession. And then they also are benefiting from lower mortgage rates. Additionally, we feel the solar loan product provides a benefit. Solar panels may actually provide cost savings compared to switching back to grid-generated power. So if a borrower becomes seriously delinquent, the servicer could disconnect the solar system and have the borrower revert to higher cost grid power. This consequence may actually provide an incentive for borrowers to remain current on their loan payment.
So that's on the loan side, and this might be getting a little into the weeds, but Cecil, I'd love to hear your perspective on the PPA and solar lease deals that you rate.
So thank you, Brian. So as you referenced earlier, PPA stands for Power Purchase Agreement. The lease operates the way you would expect, very similar to an auto lease. In those business models, the sponsor retains ownership of that underlying equipment, so they're referred to as third-party ownership. With respect to performance of the underlying collateral, there really hasn't been a difference for PPA and lease relative to loans. Homeowners are still making their payments. As Eric referenced earlier, many of the government assist programs and mortgage deferrals have provided incremental cash that homeowners are applying to their monthly utility bills. Even having said that, many of the states have provided moratoriums with regards to grid utilities' ability to turn off power, and many of the solar sponsors are following suit. Having said that, homeowners are still paying their monthly bills with the excess cash flow that has been allotted to them.
Great. So it sounds like from the consumer ABS perspective, performance has held up extremely well through 2020, and we're cautiously optimistic about 2021 in terms of credit. Certainly, it sounds like fiscal stimulus helped a lot this year, as well as hardship relief programs. And if stimulus is not forthcoming in the new Congress early next year, there might be some credit concerns moving forward. But our expectation is that something will get done sometime early next year. So I guess now pivoting away from consumers and more talking about the commercial side of the ABS market, I'd love to first start out with the aircraft lease sector, just given how active we are in that space. So Rosemary, Cecil, what have we seen in terms of the aviation market in 2020, both from a credit side and from the structure side of things?
So aviation has obviously been one of the hardest hit sectors by COVID-19 because it's been unprecedented in both the scale and severity of its impact on air travel globally. Global scheduled flights had dropped to below 40% of those at the beginning of the year in March and have risen modestly to about 53% in October. In the ABS aircraft deals, we have seen collections decline significantly due to airline rent deferral requests, delinquencies, and bankruptcies of some airlines. Collections had dropped to 35% of monthly collections in January and February as of May, but have since been increasing.
All right, so it sounds like the aviation sector has been hard hit over the last 8 months. I'm curious, given we have such a large rated book, what actions have we taken in the sector in terms of watch placements or any potential downgrades?
Sure. So, in terms of rating actions, we've reviewed our aviation book several times over the past 7 months. In early April, we placed the ratings for all of our outstanding 56 transactions on watch due to the impact of the virus and containment measures. Over the following 6 months, we analyzed the ratings on each class of notes in the transactions and have downgraded 140 classes of notes and have resolved all of the watch statuses as of now. The extent of the decline or downgrade has depended on several factors, including where the notes are within the capital structure and the cash flows in each underlying transaction.
In addition, the other things that impacted the rating actions were the credit quality of the underlying lessees themselves and the types of aircraft that were in the portfolio. So wide bodies are looked upon as less favorable in terms of retaining their value relative to narrow bodies. In addition, many of the transactions have liquidity facilities that are available to the more senior notes, the A notes and B notes. To the extent those liquidity facilities were tapped and have since been repaid, also factored into the rating action that ultimately KBRA took on the transaction.
All right, so that covers the aircraft ABS market, but I'm curious, in terms of other commercial ABS asset classes, what have we seen that has been most affected, and what have we done in terms of rating actions in those other commercial markets?
I would say the other asset class on the commercial side that has been most impacted by the pandemic is the whole business securitization asset class. That asset class generally comprises restaurants, in particular quick service restaurants. Those have been impacted by all of the quarantine measures that states have implemented around the country. Now, with respect to how those quarantine measures impacted the particular franchise system was a function of how many states were quarantining simultaneously. The United States as a country didn't implement their quarantine measures en masse. Each state was allowed to decide on its own how they were going to deal with the virus, which in a perverse way actually helped many of these franchise systems, depending on how broad their geographical footprint was. So, for instance, franchise systems are located in the Southeast, which were, generally speaking, were slower to implement any kind of quarantine measures. Those restaurants stayed open, which allowed for same-store sales, system-wide sales wouldn't approach pre-pandemic levels, but there wasn't as much of an interruption in cash flow relative to systems that were more heavily concentrated on the West Coast or in the Northeast. The other thing that actually helped these transactions was the manager's ability to waive manager fees. This is another way to essentially prop up the debt service coverage ratios in these transactions, despite the fact that the franchise system may be selling less relative to their pre-pandemic levels. This management fee waiver ability exists in the transaction. So you have to really understand how the franchise system is performing. You really have to drill down to beyond just the DSCR of whole business securitization itself. And if you peel back the layers a little bit, you can see that the franchise systems that performed the weakest relative to the others were the ones that didn't offer drive-through or curbside pickup and required customers to actually have to sit down and go inside premises. So inside on-premise dining was the biggest driver of underperformance from a WBS standpoint.
In terms of non-restaurant whole business securitizations, we rate several of those, including Planet Fitness, Massage Envy, and Primrose, which is a childcare system. Those have each been impacted based on the containment measures and shutdowns in their states, but we've been able to see that for those transactions, there hasn't been as much of an impact as we feared initially, in part because of the geographic diversity of the systems and the staggering of the containments across states.
Okay, great. I guess the final question, or to wrap up the commercial ABS side of things, just curious if we're seeing any kind of emerging asset classes throughout the pandemic, and are there characteristics of these asset classes that make them appealing to investors, at this challenging time?
So with respect to new asset classes, we have one old one and one new one in terms of new issuances. So with respect to the older asset class that's reemerging is life settlements. which is the purchase of life insurance policies in the secondary market, where the investor is paid once the insured has passed away. Clearly, that asset class is correlated to the broader market. The other asset class that we're seeing a lot of new issuance, 3 thus far in 2020, is litigation finance, in particular, pre-settlement funding, which is small dollar lawsuits where a plaintiff is suing a defendant with regards to a slip, trip, and fall. That defendant usually is insured by a highly rated insurance carrier. So the credit risk on the transaction is the settlement in favor of the plaintiff, where you're waiting for the defendant's insurance company to make payment under the settlement of the case as directed by the courts. There was a little bit of an interruption with regards to how court hearings were going to be held during the quarantine period, but through applications like Zoom and Microsoft Teams, court hearings are proceeding as scheduled. And those transactions we've rated are performing as we had originally modeled on our base case, with minimal interruptions to the underlying cash flows themselves.
So now turning to supply forecasts, which I'm sure is much more challenging this year than in years past. But, I think that most economists are calling for U.S. GDP growth next year in the range of 3.5 to 4%. And it's been pretty clear that the Fed has signaled that they will keep an accommodative footing well past 2021, which should be both supportive to supply growth next year. I see in the outlook that was published last week, we are forecasting $240 billion in new supply in 2021. That looks to be about a 10% to 15% increase from what we're expecting 2020 to end at, but still around 5 or 6% below the 2019 all-time peak. It looks like, in autos, we're expecting around a 7 to 8% increase in 2021, a 30% increase in consumer loans, a threefold increase in credit cards, but a lot of that has to do with the fact that there was almost no issuance in the credit card space this year. We're forecasting around a 15% increase in equipment, a 10% decrease in student loans, and around a 10% increase next year in the esoteric space. So, Rosemary, first I'd like to turn to you. I guess, what are some of the drivers of these increases across most of the major ABS sectors, with the exception of student loans?
Thanks, Brian. I think what we've seen so far in 2020, we definitely saw a huge decline in issuance in the second quarter as the full impact of COVID-19 took place and the market essentially stopped for almost 2 months in many segments. However, issuance has been relatively strong since, I would say, the May timeframe across most ABS sectors, except for things like aviation. And what we've seen is investors still need paper and searching for yield. And I would say that with performance actually coming in better than what would have been anticipated, and we've seen some more stability, I think that issuers have been able to continue to issue bonds. For 2021, I think we're expecting that, there is a lot of uncertainty, as we have highlighted throughout our outlook. But I think we expect that it will be a continuation of what we've seen so far this year. And I would say that we're cautiously optimistic that with some progress being made on the vaccines, that there will be a way forward in terms of moving past the pandemic to some extent.
Great. So that's, kind of an overall high-level view of ABS. Eric and Seth, so I'd love to get your thoughts kind of more down at the asset class specific level, what you're expecting in terms of supply in 2021. And Eric, let's start with you on the consumer side.
I agree with what's been said so far. I'd expect next year's consumer ABS volume to be higher than 2020, but slightly lower than what we've seen in 2019. Consumer loan issuance has been low in 2020 as many originators tightened underwriting and reduced originations until there was more clarity around consumer credit performance. Investor demand has returned and there's more clarity around performance. So I would expect the market to rebound in this sector next year. I would also expect ABS volume to increase next year as well. This will be driven by a strong used car market, increased new vehicle production. In addition, the ABS market is favorable given the tight spreads and low interest rates. As you mentioned, Brian, the credit card sector has been down for several years as large banks are using their cheap retail deposit base to fund originations rather than use the ABS market. However, given how low these volumes are in 2020, I would only expect that some of these programs will return to the market in 2021. I would also expect the number of transactions from newer near-prime programs to build out as well.
I think that makes sense in terms of credit cards. Certainly volumes fell off the cliff last year and continue to fall to almost nothing this year. But, one would think that even if it is cheaper to fund their operations through their retail deposits currently, they're going to want to diversify funding sources because that might not always be the case. So looking at the commercial side, there's certainly a great number of asset classes, that kind of fall into that area. But, Cecil, I guess in terms of at least what we rate and what we're seeing, what are your expectations for supply?
With respect to supply, speculation is that once the COVID vaccine is rolled out in a meaningful way, that we're going to start to see, obviously, aircraft ABS start to pick up. Now, my speculation, again, is on something like that, it'll probably be the second half of 2021, where we're going to start to see some kind of material issuances for the aircraft ABS space. It won't return to 2019 levels for some time, but I believe with regards to the vaccine is going to be the milestone that needs to happen in order for the asset class to return in a meaningful way. With respect to other asset classes, the low interest rate environment has really spurred on a refinancing boom with regards to rail cars and containers. So we've seen a lot of refinancings occur over the last 6 to 8 months that in the aggregate has outnumbered the amount of issuances that span multiple years. So as long as rates continue to hold, we're going to continue to see refinances occurring in those two asset classes. Other asset classes that could become more popular since people aren't traveling as much and are at home are things related to music royalties and film ultimates. So people are home watching TV and listening to music. Those business models with regards to contracted revenues coming from those respective asset classes are going to start to prove themselves out. And I would imagine that the payees under those contracts will look to start to securitizing those revenues shortly.
Certainly a lot of uncertainty next year. Hopefully it's not as interesting as a year as we've experienced in terms of the challenges in credit that we've seen in 2020. So I think it sounds like the overall tone from the three of you is cautiously optimistic about 2021. So I think we'll leave it there. I want to thank the three of you for participating and for everyone listening in today. You can get our ABS Outlook and all of our outlooks on our website for free at KBRA.com. And please look out for our other podcasts featuring the CMBS, CLO, and RMBS markets.
This concludes our episode. Feel free to continue the conversation on LinkedIn and Twitter at Quirlbond Rating. We would also like to remind you that our research and rating reports are free at KBRA.com. If you have any podcast ideas or would like to share your feedback with us, please email media@kbra.com. We hope to see you next time.